we're all really glad to be here to talk to you a little bit today about current trends in investor approaches to multi-capital value creation. And, we've had a lot of fun, I think, on our pre-call, sort of exploring what multi-capital value creation actually is and how it relates to other trends and, other things that we're seeing in the capital markets and also in corporate strategies. So, when you think of multi-capital, I think the first thing that came to mind for me was integrated reporting, right? And the 6 capitals of integrated reporting. And those capitals, as some of you may know, financial capital, manufactured capital, intellectual capital, social and relationship capital, human capital, which has been a huge focus recently, and natural capital. And I'm getting a little echo. You guys still hear me okay? Okay. So before we get started, we're going to have a conversation about this. We're going to kind of unpack a little bit of what this means and how what's happening in the capital markets, and also what corporations should be expecting as the investors are taking this more into account. I want to allow each of you to kind of give a little bit of background, each of the panelists, who you are, what your role is at your organization, and maybe just some initial comments. So I'm looking at the order on the screen for me, at least. It might be different for others, but it's Catherine, Jake, and then Jessica. So maybe we can go in that order.
Good afternoon, everybody, if that is where you are. Good morning if it's not. Thank you, Lou, for pulling this together, and to SOCAP and all the organizers for making this happen. It's a real honor to be on the stage with you, Louis and Jake and Jessica. And from our pre-conversations, I think we're going to have an interesting dialogue where I'm going to learn a lot. I am the Director of Responsible Investing and a Managing Director at RBC Global Asset Management. I joined RBC from the New York City Pension Fund, where I learned about the ability to integrate ESG factors into investment strategies. RBC had this approach, and I had the privilege of being able to join the team here. My current role is to serve as the ambassador for ESG integration and impact investing. And I act primarily as a resource to asset owners and consultants and investment groups that are interested in understanding the value proposition. And today's discussion, I think, will highlight some of the value propositions that make this such an important topic today, at this time.
Thanks, Catherine.
Awesome. Well, my name is Jake Walko. It's nice to do this panel with everyone. I am the Director of ESG Investing and Global Investment Stewardship at Thornburg Investment Management. We're a $42 billion active manager based in Santa Fe, New Mexico, where I am. So if you're wondering why is the office all pink, it's because everything in Santa Fe is. My big accomplishment is in my career currently is serving as IT staff and getting cameras and microphones working for for everything. But I've spent about the last decade working in ESG and corporate governance, including most recently at Neuberger Berman, where I was on the ESG investing team. And prior to that, having had the pleasure of working with Jessica at BlackRock on the investment stewardship team. My big interest here is the discussion of this clearly quickly evolving topic, but also keeping pace with what everyone is thinking on this. I feel like COVID is an unfortunate speed bump in all of us being able to collaborate and converse on these things, and as Kat mentioned, being well educated and up to date on these issues. So looking forward to the conversation.
Thank you.
Great. I'm very happy to be here with you all. I'm Jessica McDougall from the BlackRock Investment Stewardship team, and our team is responsible for engaging with the companies we're invested in on behalf of our clients, as well as voting BlackRock shares at those companies' annual meetings. I particularly cover industrials and materials for the US and Canada, and I'm regularly talking to companies about a variety of ES and G topics, not only to have an ongoing dialogue with them as long-term investors on behalf of our clients, but also to be able to make informed voting decisions when we cast our shares. So very happy to be here today and part of the conversation.
All right, thanks everybody. And my name is Louis Coppola. I'm a co-founder of Governance and Accountability Institute. We are a consulting organization helping companies along their sustainability journey. And we like to say we kind of operate at the intersection of the capital markets and the publicly traded company, where ESG is shaping reputation and shaping valuation. So as I said in the beginning, we had this really great conversation about what multi-capital value creation is, how it's sort of being connected with other trends that are ongoing right now. And I think it'd be great to kind of bring out some of what we discussed. So I'll open up, the conversation with this question. What does multi-capital value creation mean to you, and sort of where do you see it connecting, with other trends? And can you shed a little light on this for the audience? So this is open for any of you, or
I'm happy to go first. Louis, you highlighted financial capital, manufactured capital, intellectual capital, human capital, social and relationship capital, and natural capital. And I think sometimes these very broad topics that are really meant to talk about the intersection of a lot of different things are best explained through examples. When I was at Goldman Sachs, we looked at intellectual capital and human capital, and we saw that our assets rode the elevators and left the building every night. Well, when we were not working all night. And this reflected that combination of intellectual capital and human capital. Today, that's reflected in the market value of Goldman Sachs. Like financial services technology company valuations are also reflected in intellectual property. It's hard to point to the assets owned by Facebook or Google, but we can look at the intellectual property and the value of what they have accomplished. That's very different than decades ago when we looked at steel companies and auto companies, and their balance sheets showed us what their valuations were. It was property, plant, and equipment, and that was the primary driver. So really, we're in a different place today than we were, and the S&P 500, for example, is really concentrated in technology companies where you don't have those balance sheet issues. And so value starts to be something less directly measurable by numbers that are on a balance sheet. And all of these things, as I said earlier, do contribute. The ones you talked about, Louis, they do contribute to the valuation. So, another specific example, and then I'll pass it to my fellow panelists. COVID has highlighted the essential contribution to company value of human capital. Its ability to pivot to working from home, the importance of keeping the workforce healthy and safe. So this is why ESG integration is important in assessing the valuation of a company, and why a multi-value capital model looks to value creation in a much broader, more global, and I would argue holistic sense.
Yeah, your comments remind me of, there was a slide that I've seen in decks, and we've used it over the years, where it was showing intangible value versus tangible value, and it was sort of icebergs, right, in water, and going back to like 1960, 1970, most of the value was tangible, right? It could be, looked at from the accounting metrics, but over time, more of the value of a company became intangible, goodwill, other things that I think are related to these capitals, right? Like, as you say, I think now I think the chart is more like 20% tangible and 80%. That's my, my opinion and what I've seen on these charts. 80% of the value is intangible. It's very difficult to look at just the book value of a company, and that's so far off from what the market is valuing it at a lot of times, because they're taking into account, I think, some of these capitals in some ways. So thanks for that, Catherine. What do you think, Jake? What's multi-capital value creation mean to you?
I think you hit the nail right on the head, and in many ways, what I was going to start with is that it has always been this focus on research and valuation, right? Fundamental research and fundamental valuation. And what you mentioned in terms of the intangible value of companies, and the growth of that over the last 3 or 4 decades, especially starting accelerating in the early 2000s and following through in the last decade. It's easy for folks to wrap their heads around the idea of a brand being valued at something, right? So the label is worth something very specific. And so when you do valuation work on a company, its cash flows, you factor in its balance sheets, and its credit position and so on. You can put some dollars on the future cash flow generation of that brand, but there hasn't been a lot of work on the value of employees, as Kat mentioned, or other parts of the intangible assessment, including the regulatory favor or disfavor that a company enjoys, or the community landscape that it operates in, and how it may bode well or not well for its future. So a lot of what it means to me is trying to put some numbers behind these ideas, right? And I would say that, a decade ago when ESG was in its, more, I always feel like ESG is in its nascent form, but so we'll be moving the goalpost there for the rest of our careers. But it was genuinely difficult to do these kinds of assessments. Since then, we've had such a major advancement in the way that frameworks and methodologies have become transparent. SASB has emerged, obviously PRI has emerged, more people are thinking about this. And now I feel like we're finally in a stage where there are numbers behind these things, or there's at least qualitative, assessments and narrative that helps investors look at these things. So the research is what I'm focusing on, and that is getting much better. The other thing that I'll explore further in some of the other questions is really the value for businesses to align with their clients. So we are an asset management business, and yes, we want to find investments that are delivering the best value for our clients, but our clients are increasingly saying, that's not all, right? So there's a consideration here for how companies care about these different capitals that is beyond valuation and into just the commercial motivations for businesses in general.
Mm-hmm. Yeah, talking about standards, just this morning I saw an article that TCFD is being mandated in the United Kingdom. That was amazing. On top of the EU's directive for non-financial disclosure a couple of years ago, that's being implemented now. So we're seeing all kinds of things around standards, right? And the different groups that were announced over the last few months to kind of bring together the standards and try to align them in different ways to meet the needs of both this, corporate companies disclosing and also investors, utilizing the data. So that's interesting. What do you think, Jessica? What does multi-capital value creation mean to you?
Well, I would certainly echo much of what's been said, but I do think it's very important for us at BlackRock as long-term investors to understand how companies are considering their stakeholders and taking into the account company is impacting the environment, how they're treating their employees, again, how they're valuing human capital as a long-term asset of the company. And I think something that Jake said is really important, that the conversation is evolving and companies are much more willing to talk about how they are considering these various elements, these non-financial elements that nonetheless play a very important role in the long-term outlook of a company. So, in an ideal world, I think that there aren't ESG factors and fundamental factors. They're just factors in the way that companies are considered. And some of them are financial, some are not. But, I think one big hurdle to that is that we are still in a system that is grounded in quarterly reporting. And we know that these kind of non-financial metrics, especially those that are called out by SASB and the metrics and targets of the TCFD, are very hard to quantify on a quarterly basis, sometimes very hard to quantify on a yearly basis, let alone over a 3 to 5 year period. So I do think that timeframes are a little bit misaligned, but I'm excited to see how there is some kind of convergence across the market.
Mm-hmm. Yeah, moving from short-termism to long-term planning strategy. You see some companies like Unilever moving away from quarterly guidance, which I thought was amazing. ESG is not going to play out. You're not going to be a day trader, right, trying to trade on ESG. It's just not going to happen. So
right.
You need companies to start thinking more long-term and investors to start thinking more. I think in some ways, sustainable investors, we like to say that you attract long-term patient capital to your company when you have a leading ESG profile, because most of the if you have a sustainable investor, they're mostly looking at long-term already. Pension funds, sovereign wealth funds, some of the larger leaders in this area have really long time horizons, 30 years till their fiduciaries retire. So
right.
It's a great point. So one other thing we talked about during our call was sort of moving from this shareholder primacy towards a more stakeholder inclusive capitalism model, sort of like what the Business Roundtable's letter recently put out a new statement for corporate purpose, right, which introduced a shift away from the primary, purpose of managing the company to only generate shareholder profits, disregarding everything else. Of course, we want shareholder profits. That's what we're in business for, right? But there's a lot to be said about these other stakeholders and including them in your strategy and policies and engaging with them and understanding and growing the relationship with them as a company. I mean, growing the relationship with these stakeholders, gaining the trust of your stakeholders. That can lead to resiliency and gain new clients, get better employees, right? And all the other benefits that we talk about with ESG. So when we talk about, this move from shareholder primacy to stakeholder value, are you guys seeing in your organizations, is this playing out, this kind of transition right now? Having a more stakeholder inclusive model in the way that you're assessing companies or engaging with companies?
So at least from the BlackRock perspective, I think that the consideration for stakeholders has been in our engagement priorities for the last several years at this point. And, a key engagement priority for us is human capital management. This year, we have been increasingly asking companies how they are working to create an inclusive, diverse, and equitable employee base. So I think that comes with we're asking for disclosure today, but with the aim of trying to understand how a company is considering this element of their business and really working to create a culture that helps to foster innovation and ultimately can help propel a company forward. So I think that's one, key example of a stakeholder group that is very important to companies, and especially now understanding how companies have a role to play in engaging their workforce and also can truly benefit shareholders when they have that culture that is, again, fostering a sense of innovation and, forward-thinking strategy.
Mm-hmm. Anybody else?
So one thing that I would just sort of frame this with is there's an important dimension here to just the intersection of capitalism and democracy, right? Because when you think about sort of capitalism traditionally, right, you would have the focus on the shareholder returns, but really not much of a thought given to, what is happening with regards to the community in which a company is operating in. But there's an important element here where if the community ends up being dissatisfied with the company because of its conduct, right, not only does that threaten its license to operate in that community, but because we live in a very open world where information is easily disseminated, the company may not have a lot of options of where it may go with operations in the future and not have that controversy follow it, right? So in many ways, companies ignore these things really at their own peril, right? Especially larger companies that operate in multinational environments where, it may be easy to say that in a particular jurisdiction, this particular element of, whether it's human capital or community relations, maybe it doesn't matter here. But if you want to sell your product or operate in the UK where the, expectations are much higher, they'll know about it, right? And it takes a long time for companies to establish reputations, positive reputations, right? The famous saying about, it being a much quicker way down on that, right? So it's important for companies to really take a step back and think about themselves as not only where do we operate now and how are we perceived, but where might we want to operate in the future? Where might we want to sell our product? And consider the expectations that those communities and jurisdictions are placing on players in their environments.
Mm-hmm.
So you all raised some really interesting points that I'll just add some editorial comments to, if I may. The first one is that there's sort of a societal overlay on all of this, which we think of as societal, but is really proving over time to have direct economic consequences. So I believe Citi just came out with a study that said that racism has cost us $17 trillion. Mercer has done a lot of work that said countries that are more inclusive of women in business have a higher GDP. So there are real bottom line measurements that are starting to come forward. And it goes to, Louis, your point about long-termism versus short-termism, and that most shareholders are interested in long-term value creation. And we at RBC, who have practiced some of these or have implemented some of these practices in some of our strategies for over a decade, have seen that there is a long-term opportunity here, investment opportunity, sometimes short-term, but often long-term. And I posit that the investors care about the long term, but the incentive system we've often talked about is driven by quarterly profits. And that's what's driving the corporate management to focus on short-termism and short-term results. And, I said during our prep call that I would keep bringing us back to examples because I think illustrations are the best way. So yesterday, Pfizer announced success in COVID-19 vaccine trials. So for whatever time period, that has been a major and will continue to be a major hit to their expense, their financial expenses as they invest in R&D to get this. But I think the market and that reduces their earnings, but the market probably recognizes that however, whatever percentage of probability you assign to that as a success, this could have massive long-term value for the company. So R&D is an expense, but this is intellectual and human capital and is directly reflected in the long-term value, and in this case, potentially much shorter-term valuation of a company. We have a client who's the treasurer of a well-known household name corporation, and this treasurer was pretty skeptical about sustainability, and yet there was a drive in the company, partially because they saw an interest in customers, and they also saw some sustainability practices. They produce a lot of waste in the product they sell, and that recycling practices would help. And they started integrating sustainability across the organization. And what he saw was a reduction in the cost of raising capital. Direct correlation. So we think of these as non-economic, we think of them as non-financial, but when we actually look at it differently, and we see that that's not the case, and that if you take a slightly longer term view, and if you also widen your lens, as we're talking about with the multi-value creation model, it gives you a greater insight into the potential for true value here for the shareholder and for the economy, as Jake started to say, mentioned before.
Yeah, I think that's a great example for intellectual capital, right? The Pfizer. Yeah, I mean, I never really thought of it that way, honestly. But that makes a lot of sense. And that, that leads into and building on what Jessica and Jake, responded to on the question too, kind of leads into my next question, which is, the interconnection of, stakeholder inclusion or stakeholder capitalism and shareholder value, right? Because, it's sort of presented as, you're either managing for shareholder value or you're managing for stakeholder inclusion or stakeholder purposes or returns, but it's not really a choice of either or. I don't think. I think including stakeholders in your decision making as a company and also as you're analyzing possible investments actually connects and leads to either the creation or destruction of shareholder value, depending on how those topics are managed. So, building on that, do you guys, have you thought about sort of this interconnection? Have you seen that playing out? And are they connected? Do you agree? What are your thoughts on kind of that interconnection of shareholder value and stakeholder inclusion? Or multi-capital inclusion?
Yeah, we definitely are seeing it. And I think, as Catherine mentioned, there are some real examples of companies that are taking on what might be considered sustainability steps, which actually end up being profitable for their business or allow them to capitalize on greater market share. And, one example that I think is just a great example of this is a company that I cover that had divested away from plastics 20 years ago or so, and have really made a concerted effort on making a product. They're in the aluminum cans business that is reusable, recyclable, and essentially this idea of circularity. And the company made that decision 20 years ago as they were noticing that plastics were not being recycled in it potentially should be, or reused in a way that was sustainable. And they really wanted their business to have this element of reusability and be able to cater to the market in that regard too. Mm-hmm. And it turns out that aluminum cans have been really big in the spiked seltzer market. And millennials, broadly speaking, are much more in tune with sustainability aims and buying from companies that have elements of sustainability in their value chain. And so this company has been able to talk about how their singular product based on aluminum is reusable, recyclable, embodies this idea of a circular economy, and can cater to an area of the market that is particularly keyed into these issues and a drink that they just happen to like. Mm-hmm. So I really like how this company has a story that is, it's created a lot of value for shareholders, but it makes sense from the cost of the materials they use, as well as the way in which they're able to market their product.
Wow, that's awesome. I think a lot of companies are thinking about how do they align their strategy with millennials in that kind of way, because that's the future, right, of consumers. So that's a big driver, and also attracting talent from that pool. So that's a great story. Thanks for sharing that. Does anybody else have any other tidbits they'd like to add on that topic?
Jake, do you have thoughts?
I'm mostly I wanted to just say something in defense of maybe the traditional understanding of the shareholder primacy, since we're talking about the interconnection. You know, it's interesting, right? Because one of the things that I think is important to dispel is this idea that shareholder, when you look at the shareholder register and you see financial institutions, that those are somehow the investments of those financial institutions, but they are just investments of those institutions' clients, right? And in many ways, when you really reflect on who owns these assets, right, they are stakeholders. They may not be stakeholders in those companies, in each of those specific companies, but they are stakeholders somewhere, right? Most of those owners are, in fact, normal people, average people, you know, through their 401k investment, you know, owners of the corporate pension plans who are all kinds of employees within those companies, who may be located all over the place, right? And you know, when I think about shareholders, I really think about, you know, teachers and firefighters and, you know, churches and others who are commingled into these investment platforms that own those companies, right? So you know, I think maybe, you know, I'm not enough of a theorist on this, but maybe shareholder primacy and stakeholder primacy are heading in the same direction, in the sense of, if we were to really understand who it is that we are serving as asset managers, who are companies serving in terms of the you know, ultimate beneficial owners of their performance, we'd realize that it is a lot of communities and it is a lot of normal people that maybe don't fit the mold of, you know, kind of you know, the kind of the political dimension of the idea of you know, financial institutions, right? So so I love the example that Jessica brought up. I think that's an example of a company that gets where the world is going and aligns proactively towards that, right? And I love that deep research, economic value creation element of it. But the, you know, the kind of the question of who owns the assets is equally important.
I just want to underscore, and perhaps I'll start with a question and I'll end with the question, which is there really a divergence between stakeholder capital and shareholder value? And where do you see it? The only place I can specifically see it, and even there it's a bit of a stretch, is in a stock buyback program. But, you know, it seems obvious that there's a connection between customer satisfaction and brand loyalty. And we've talked just now about millennials and what they're looking for in their focus on sustainability. And the NYU Stern School of Sustainability has done some research and showed that even if something is just labeled sustainable, if you look at products that are just labeled sustainable versus those that haven't, in the past, from 2013 to 2018, grew at 4.7 times the rate of those that didn't. So there is true economic and measurable economic benefit of the sustainable brand. And I think the issue is more, how do you measure it and how do you track it and where do you track it? Where do you report it so that, you know, a sustainability officer in a corporation can say, no, I'm not a cost center, I'm a revenue center, I'm contributing to the bottom line, and not be caught in this, you know, this is a soft science. I don't believe this is a soft science. I think we're looking for tools in order to attach this to numbers, because we are a numbers business. And Jake, you're absolutely right that who is the shareholder and the stakeholder, but, you know, think about customer satisfaction and brand loyalty, right? Or employee satisfaction. So customer satisfaction leads to brand loyalty. Cost of customer acquisition is really high. So your expenses will go up if your customers leave you, okay? Not to mention that if you have brand loyalty, they're going to probably buy more brands that you sell. I'm focused on consumer goods in a sense right now because it's just sort of something we're engaged in every day. Or employee satisfaction and productivity. There is a direct link between these two, and that affects the bottom line. And when we talk about stakeholders, we include employees, we include customers, we include a much broader sense. And so maybe it's not that they're separate, but maybe it's just that we haven't found a way to actually measure the contributions of that, and to therefore empower both the investment firms that are focused on this, like RBC, like BlackRock, like Thornburg, and the companies that are trying to do this, and the sustainability efforts that their sustainability officers are trying to achieve and get support for.
Yeah, in some ways, the BRT letter is kind of following, what has already been happening in the market. It's and yeah, I mean, I would ask this question, which I think, will connect the point that everybody's made, that really these aren't, as different as it seems. What would you think of a company that ignores their stakeholders completely and just moves forward with their business? Is that good governance? Is that good practice? Is that good strategy? If you ignore your customers' complaints about something, and then you ignore the complaints coming in from your employees or the turnover ratio, that they're leaving and flocking to other companies, just don't worry about it. That's just stakeholder stuff. Let's not look at it. Would you invest in a company like that? Would any of you, would it impact, your assessment if they just blindly did not look at stakeholders? I don't know if there's a company out there like that. I would think that they might be out of business, if they did that. So a lot of this is terminology, maybe in some ways too, and educating people about the different terms that are being used and what they actually mean and how they flow through. So that's why I'm glad that this conversation sort of led to a discussion about the definition of these terms and what they actually mean. Because like the word sustainability, when you say it to someone, I feel like you say it to 20 different people, and the 20 different people all have different perceptions in their mind of what sustainability actually is. So it's good to have these kind of discussions. So when you guys are actually making an investment decision or looking at a company or engaging with a company, going through your normal business, how does these kind of considerations play out? What are you looking at? Do you have any kind of insight into how it actually plays out in that process?
So maybe I'll start, and it's very simple, right? When we engage with companies, some of those companies are already in our portfolios, but they might be in several portfolios, including our ESG funds, or we might be looking at a company at a potential investment, in which case we would be evaluating it to understand whether it can be admitted to all of those funds, including those ESG funds, right? So even though you're engaging with companies on aggregate, those companies internally have a lot of sort of clients, if you think of the funds, the full fund complex as clients. So the ESG evaluation is important, because if you are, failing or not quite performing on that area, then you would simply not become eligible for inclusion in those ESG funds, or you wouldn't, those funds wouldn't be interested in you, right? So in many ways, I think that the single thing that is powerful that I can say to companies is, in some ways, not getting ESG questions is its own problem, because it means that you are likely in not having investors who are focused on that, in which case you're missing out on capital, right? And if the responsibility of the company, the board, the management team, and so on is to make sure that you realize a healthy multiple as a result of your positive view, in a positive view of you in the marketplace, then you're failing at that, right? So. And we do know that companies that are viewed as more sustainable do have better multiples and sell for better multiples. So that's sort of, the questions might be all over the place, but our internal evaluation might be harsher at the end of the day than what we're letting you know about as a company.
And I would briefly echo what Jake had said. So, our clients are very interested in investing in companies that are disclosing how they're considering broadly, and part of that is how they're considering their stakeholders. And we have funds dedicated to that, active portfolios that are looking to put money with companies that are embodying these traits, and with an idea that companies that are considering these elements and disclosing them transparently to shareholders will inevitably do better because they're considering their companies from a variety of different factors and taking a very holistic view on where they see themselves in the future. And so I definitely agree that companies who are acting as best-in-class players, talking about this and really embodying these elements, or even sometimes just managing these risks, are able to attract capital in a way that other companies are not. And I think that will just continue to grow.
Mm-hmm.
I agree with all of that. And I just add one more comment along those. In engagement, it's not necessarily that they're doing it now, but they have a plan to move towards it. And understanding that, which is really a conversation with management, and in some ways a probing or drawing out conversation with management, can help you understand that. We sometimes talk to small cap companies and we say, well, what's your sustainability plan? And they go, what's that? And they're vendors to large corporations and suppliers, and they look at you like, excuse me? And then you say, well, it's this. And they go, oh, well, we do this and we do that and we do that. That's to your point, is that the language is sometimes a great barrier to understanding. And so direction matters, not that you're already there, but that you're moving. And then not only that, but if you say, we're doing this next year and the following year and the following year, to make sure you're on track for that plan and following through on what you promised.
Mm-hmm. Yeah, we've been tracking at G&A the S&P 500, right, and the Russell 1000, how many companies are publishing formalized sustainability reports over the last 10 years. And, we went from 20% of S&P in 2011 and now it's up to about 90%. So there's 1 out of 10, though, right, that are still, these are large cap companies. We see smaller cap, right, and mid cap not doing as much. The argument is they don't have the resources to do it. But as Catherine points out, they're being pressured by larger companies that are going out to their supply chains and asking for more information on this. We see that all the time. But there's still 1 out of 10 large cap companies that aren't publishing a report. Now, we tend to see this in, high growth companies, sort of innovators, that the stock is just flying through the roof and they say, we're on a run right now. We don't need to focus on this. The shareholders are more worried about our growth. They're not as focused on ESG, maybe thinking, this is from the company's perspective, not mine, thinking that they don't need to do this because they've got so much momentum or whatever, that they're okay for now. They'll look at it later, next year, the year after, when things start to settle down or the price goes down. So, 1 out of 10, not all of them are in that bucket, but why do you think companies are, why do you think there are still some companies ignoring this? I don't know if there's a good answer. I want to see if any of you guys have an answer for this, but can they continue? Do you think they can continue to do this and ignore and not report on their sustainability?
Can I take a crack at that? Because I was really inspired by this question. I'm really inspired by this question, Lois. And I think status quo thinking is really powerful. Human beings don't like change. But here we are at a moment in time where we have an opportunity to think differently. Since March, the status quo has completely changed. We live differently, we work differently, and brand managers know that changing life circumstances like a marriage or a birth of a child or a retirement are the best opportunities to get people to change brands. And I would argue this is the moment to change brands, to change your thinking, to see, by the way, that we're all interconnected, that a virus in Wuhan can affect us. We had an assumption that it wouldn't. And look, the whole world is affected by that. So we are interconnected. And all of these multi-capital market models, they reflect that interconnectivity. old thinking is a one-to-one relationship. But we all know that some of the parts are greater than the whole, and corporations are no exception. So that was my enthusiasm for that question.
Thank you. Anybody else? Any comments on like what is it going to take, for these last holdouts? How do you address them? They must be in your portfolios.
Yeah, so I think for some companies, especially smaller ones, there is an investment required. There is some kind of enterprise risk management system that needs to be able to capture data to make sure that it's accurate, especially with regard to emissions or energy usage, or some way for them to be assured that the data they're reporting out is consistent. And again, there's some kind of verification of that. So I think there is a hesitancy for companies to sometimes invest in those systems and disclose in greater detail these kind of metrics. If you look back 10 years ago or so, companies were frequently talking about their corporate volunteer hours, their community gardens, these CSR reports, but that's not really the sustainability reports that we want to see today, or kind of the data-driven reports that we're seeking today. So I do think it's a bit of a change in mindset. It's the way in which some companies are able to see the value of when these considerations are integrated into their business. It creates greater efficiencies, energy savings, emissions reduction, waste reduction, and ultimately some kind of dollar value at the end of the day. But it is a mindset change. And also, in some cases, companies willing to say, this is not a separate report that we do. This is not something that is nice to do for our stakeholders, but it's the way we do business. And that's part of our value.
Mm-hmm. It's very interesting. I think, Jake, do you have anything to add to that? Agreement, disagreement?
Agreement. That was very elegantly put. So I'll leave it there.
All right, great. I agree. So, I think maybe what we can pivot to a little bit here is the question that I think, or a topic that we can't really ignore this year. Well, there's many actually, but one is, the COVID pandemic, which we've briefly mentioned in some comments. But as we've alluded to, a lot has changed since March 2020, or around, give or take a little bit. And there were trends in place that were already going in a certain direction, some like remote working, shopping online, right, which were accelerated by the COVID pandemic. Many companies said, well, our employees can't work from home. Our kind of business, that's not going to work, right? That was the statement. And now I think, it's because of this, they've been proven wrong in some cases, right? Because they've been forced. What do they say? Necessity is the, I forget the exact saying, but necessity is the
mother of invention.
Thanks, Catherine. Sorry about that. So ESG, I think, too, in some ways was a trend, and multi-capital value creation was a trend. Stakeholder inclusion going into 2020 was already accelerating, right? We've all seen the different charts everybody puts up in surveys and everything, where you have the hockey stick over the last 3, 4, 5 years or more, but especially over the last 3 years. And after COVID, we've probably, some of us on the panel have seen, and maybe some in the audience, these studies showing that ESG investments or funds, right, had less capital outflows during the crash, or whatever you want to call it, the flash recession or whatever it was, maybe still to be continued. So, it sort of accelerated, I think. At least we've seen that in our business, right? I mean, wow, we were already growing over the last couple of years. It was slow and steady March. And this year, it just seems like everything, blew up. We are getting way more phone calls. You see all types of topics, studies, standards, and it's just become a lot more sophisticated. And I'm wondering, what, in your organizations, what has changed since COVID? Are there different topics maybe that you're more focused on? Has, stakeholder inclusiveness or some of the capitals, come more into focus? What has been your experience, since March?
I think from our perspective, there's just been a lot of questions around things like COVID, right? And the sort of the pace of evolution of these things. The challenge is that, clients are asking, but there's not, it's early, right? And it's hard, and new concepts are, take a while to really hash out, right? SASB is a perfect example of that. We've known for a long time before SASB standardized a lot of the material factors that those things mattered, but there was a lot of disagreement over what KPIs and, where is it material to what companies. So I think it's, I see it as a huge benefit that people are asking about it. But I do think that asset managers need some help in the sense of, we need examples of great companies that have cracked the code and are measuring something meaningful that we can take in, and then obviously other companies to follow the same standard, and perhaps wishing for some kind of regulatory discussion or standard around these things, as we've seen from in the questions that were posed to the SEC around human capital management measurement, for example. So a lot of interest, a lot of challenges. I don't have any answers.
Yeah, I think at least from our perspective in talking to companies, this really showcased the companies that were just all talk and those that were, really walking the walk as far as these ESG considerations. There were some companies that I talked to, and just the way that they spoke about the actions they took immediately in March and April, and the care that they had for their employees and donations to their communities, and, the way in which they were helping relief efforts was just head and shoulders above other companies, and the way that they truly felt a call to action and a responsibility to contribute where they could. There were some great examples of companies within the industrial space that I cover that were helping to get ventilators to hospital, donating PPE, and everything that you would expect for companies that have the means to do, to, donate where they can, but also understanding that their communities were suffering, and, their employees had family members that were sick, or family members who had lost their jobs, and they were contributing to local restaurants, trying to support local businesses, giving their employees more paid time off, sick leave. And so they didn't have to worry about, being able to buy groceries and take care of their loved ones who were sick. So, there were some companies that just acted so quickly to do these things that cost them money, but I think they got their returns back 100-fold by the way in which their employees, I'm sure, will never forget how much their company was there for them when they most needed it. And so I just think that this was an opportunity for those companies that had these values instilled in them to really shine, and others that were just putting that in a glossy report. It was just very obvious.
Jake's talked earlier about how we are really fiduciaries for other people's money, and that we primarily sit in front as an investor, but with investors behind us. And what we have seen is a real almost wake-up call that every dollar has an impact, and that money is not neutral. It is not neutral. And it has a message with it. Millennials are responding by making decisions, as we've talked about, on what companies to buy from. Who do they want to give their disposable dollars? Where do they want to buy their coffee or meat? Or how do they want to stop eating meat? And all of these things that are are very much in the daily purchasing decisions of people. So we are seeing that there is a real motivation to do more with your money, and a real push on advisors and asset managers to understand this space and to be able to interact with their clients, the investors that they serve, on this topic, and to take it into account and to know how. Jessica talked about values. In some cases it's values, and in some cases it's the value proposition. But certainly I think the values piece of this has accelerated dramatically as we see at a really simple level. I think, Jessica, you're the one who mentioned, neighborhoods, and maybe that was Jake. As we see the stores that we walk by every day out of business and wanting to take action to help in some way, and seeing that investment dollars can make a difference. Mm-hmm.
Yeah, I remember at the beginning of COVID, seeing all the companies announcing, like you said, Jessica, announcing what they were doing. It started with like a trickle. You saw one company saying they're going to do this, and then another company saying they're going to create PPE, and another, and then it just became a waterfall. I mean, company after company, committing to do something, and it was inspirational. I think even from any stakeholder, as a customer, as a employee, as an investor in that company. And I think it was almost like it was a pressure tester. COVID was like a pressure tester for companies' commitment to certain multi-capital, certain capitals. Was the commitment to their human capital, was it real? Was it there? Are their employees going to be able to adapt to the new environment that we're operating in, because they've been given the policies, the tools, the leeway, the flexibility, right, and the systems and the technology and everything around it that would enable them to pick up the next day like nothing, not like nothing happened, but with a minor disruption to business, versus a company that it was all fluff, like you said, and when the pressure tester came on, it didn't work out well, for those companies. So that was a great example. I really like that example. I see we have 3 minutes left, so I would let you guys, if you want to make a closing comment, happy to, each of you could have like a minute to leave the audience with something or say thank you, and I'll again do the same round. I'll first just say thank you to everybody for participating, the panelists. I thought we had a great conversation. I really enjoyed it. Personally learned a lot, and thank you for everybody who's here listening to us and taking the time to tune in. And I'll pass it along. We'll go, Catherine, Jessica, Jake is now the order on my screen. I think it's switched around, but Catherine, you can.
Just say thank you. Thank you, Lewis. Thank you, Jessica. Thank you, Jake. Thank you, SoCap. This is so important. It's a relevant topic. It's a misunderstood topic, and these are the kinds of conversations that help us think more broadly. And bigger thinking, different thinking, new ways of thinking are all really important at this moment in time. And I hope those of you in the audience who have joined us found this useful, and will just in a tiny way maybe think a little differently tomorrow than you did today.
Yes, very thankful to have been part of this conversation. So thank you to my panelists and the audience here. And I certainly would echo what Catherine has said. I think this is a really unique opportunity for companies to consider what's ahead and how they can position themselves for a future. And, especially as we look towards an economy that is, transitioning to a lower, focusing on climate change especially, but really see this as an opportunity to rise to the occasion.
Yeah, in a similar way, I think I would sort of frame it as, these things, these different capitals as having been once upon a time nice to haves or positive things that companies were doing out of their own volition and desire to be better participants in the markets. moving to explicit expectations and maybe one day in the near future, actual requirements. So these things are evolving, but they are evolving in that direction from my perspective. So thank you for having me, and thank you to the fellow panel participants.